Hello, I'm Vaike O'Grady, Austin Regional Director for Metro Study. I wanted to get with you today about the second quarter Metro Study results and share some highlights with you. Before we jump in, as we recognize that job growth is the key driver for housing, we need to look at how Austin job growth is happening today. Austin ranks number 12 of the CBSAs with 1 million or more in the United States. That means we're tied with Miami, Fort Lauderdale. Now that's a few spots lower than we were in prior years, but still very respectable at 2.8% job growth. If you're curious, well, you see Dallas is at number 4, San Antonio came in at 15, and Houston ranked number 23. But you see that we're down quite a bit from our peak. A year ago, we were creating 35,800 jobs over a 12-month period, which meant we were experiencing annual growth of 4.4%. And we'd gotten used to that number. In fact, over the past 5 years, the job growth rate in Austin has increased each year an average of 4.3%. But since November of 2016, we've been below 4%. It's nothing to wring hands over, but we may be feeling that slowing as we return to a more normal market. We are stronger than the United States, however, which has been running at 1.4%. In terms of job growth comparison on a monthly basis, it's hard to see significant trends. But in March of this year, we got a nice bump when compared to last, but May was pretty discouraging, and June was essentially flat compared to 2016. July is typically a job loss month, but maybe we'll get a nice surprise. While we experienced growth across virtually all industries, there is starting to be some concern that some of the largest increases in mining, construction, education and health, and leisure and hospitality sectors are a result of growth itself. After all, home builders, teachers, doctors, and waiters all have benefited from the intense immigration over the past few years. We've seen higher rates of growth in manufacturing, financial, and other services sectors, but they contribute less to Austin's economy overall. Moreover, the information center, where tech resides, has been fairly flat. We'll need more jobs in the tech sector and the other three as well to fuel the market going forward. Unemployment in Austin has been very low. We've been below 4% since October of 2014, and while we increased to 3.4% in June versus 2.9% a year ago, we're essentially fully employed, and that's put pressure on wages. And we'll need those wage increases because the median priced home in Austin now costs more than $75,000 than it did just 5 years ago. While incomes have grown and will continue to grow, they are not keeping pace with home prices. Yet intense demand has not slowed. Increasing prices aren't affecting the sales volume. June represents the 6th month in a row that home sales were stronger than the year before, and overall home sales in June were 6% higher than they were a year ago. We hit a record $1.4 billion in sales volume in June. Our previous peak was just above 30,000 annual sales pace in 2006. We've met or exceeded that sales pace number for each of the past 5 years. Yet supply is growing, and that should help with some of the price increases. We had 8,597 listings in June, and that's an increase of 20% year over year. It's the highest number of listings on the market since October of 2011, and the first time we've been above 3 months of supply since October of 2012. So again, a return to a more normal market. In addition, multifamily performance is starting to slow as well. When you look at occupancies, it's still just above 91%, but rent increases are slowing and concessions seem to be growing. Desire for home ownership is still real, and these renters should provide an audience for home buyers and to come into new homes, but high rents may be a barrier to them saving for a down payment and making the move. So let's look at Metro Study statistics. In the past 12 months, we started 15,459 homes, which means our annual sales pace is 32% higher than it was a year ago. That's the highest pace of new home starts that we've seen in 10 years. And at our peak, we hit just over 17,000 starts. Annual closings continued to increase as well, though not quite as fast. And the gap between starts and closings continues to widen. This is reflective of the number of new lots coming online, as well as the amount of spec home inventory being started in anticipation of a strong spring selling season. We'll expect to see that closings number improve as the year progresses. This chart shows the huge bump in single-family starts during 2Q. We started about 1,000 more homes in this period than we did a year ago, and for the year so far, we are about 1,000 units ahead of last year's pace for starts. Again, closings did not pop up quite as far yet, but we've been above 3,000 closings each quarter for the past 6 quarters. Who knows, maybe we'll hit 4,000 next quarter based on these strong starts. When you look at sales per model, we're running at about 24 sales per model, but it changes depending on price point. If your base price is between $200 and $249, you're seeing about 38 sales per model. For models base price between $400 and $500,000, you're seeing about 15 sales per model. The heart of the market in Austin is between $200,000 and $300,000, and you can see the huge growth in starts in those two categories, 200 to 249 and 250 to 299. That's almost half the starts in the market, so it's what's fueling us. Every segment above $300,000 also grew, but not quite as fast. From a starts comparison, when we compare 2Q16 versus 17, you see multiple jumps in starts across different price ranges. The only place that dropped was in the below $200,000 price point. Quarter by quarter closing comparisons show a big bump in closings between 250 and 299, which indicates that strong demand for that segment. Closings have been lagging in the $500,000 to $600,000 price point, but they're up in the $700,000 and up, which may reflect finished inventory being sold. Here are the top 10 submarkets in Austin, led by Cedar Park Leander West, which is west of 183A. The top 3 submarkets, Cedar Park Leander West, Pflugerville, and Kyle Buda, combined for nearly 4,500 starts, which is about 1/3 of the starts activity. Number 4 and number 5 on our list, Del Valle and Hutto, wouldn't have been on the radar just a few years ago. And now a look at the top 10 communities ranked by annual starts. Sienna and Hutto topped the 500 mark with 506 annual starts, making the national list for one of the best-selling communities. The rest of the communities on the list hover between 200 and 265 and are all performing well. The vast majority of them are in the north submarkets. But the big story for this quarter is inventory. There are now more than single-family homes under construction than we've ever recorded, up 30% year over year. And while the level of finished vacant inventory has grown as well, our strong sales pace means we're still only at 1.9 months of supply overall. The target for housing inventory months of supply is 6 to 7 months for a balanced market. So you can see that we have supply above equilibrium at $300,000 and up. When we look at the target for finished vacant as a percentage of housing inventory, we try to keep it below 30% of all housing inventory. Overall, as a market, we're at 24.8, so really not a concern. Where the concern starts to show, however, is in the $350,000, $400,000 price points. That's where we've got a lot of builders competing for that move-up buyer and perhaps are a bit oversupplied. Here you can see it by vacant by months of supply, and you see we're hitting up at 2.7 months of supply, closer to that resale number of 3.0 when you get above 400,000. Now let's talk about vacant developed lot supply. When we look in the market, we try to target between 22 and 24 months for equilibrium. We're currently at 18.8 months of supply, which is reflective of the strong market. Again, that varies depending on your submarket. In submarkets that have 100 plus starts, vacant developed inventory tends to hover around 20, that equilibrium point. We have outliers in Bastrop, thanks to Tahitian Village that's been around for a long time. Dripping Springs and Lake Travis North tend to be a little bit oversupplied when it comes to vacant developed lots. And there are more lots coming. 9,607 lots were tracked under construction as of 2Q, with the vast majority of them estimated to complete late this year. Here's where they are located. Cedar Park Leander West has nearly double the lots underway as Pflugerville, its next top competitor. San Marcos and Georgetown West also made the top 5 for the first time in terms of lots under construction. And then lots brought to delivery in second quarter is up 5.7% year over year, from 16,769 to 17,725. That is the highest pace of lot deliveries ever recorded, so there is plenty of lot supply on the ground. The top 4 submarkets, Pflugerville, Kyle Buda, Manor, and Cedar Park Leander West, brought online over 6,500 of those home sites. So we see growth along the 183A and the 130 corridor. The good news is that the bulk of those deliveries are in the $200,000 to $300,000 price point, where there is more buyer demand. Speaking of buyer demand, the top 10 builders in the market, Austin continues to be dominated by larger builders, with D.R. Horton bringing online 2,414 starts over the past 12 months, about 17% of the market. KB Home does about half that business, and you see how it shakes out from there. It's notable that there is a good variety of regional, local, and national builders on this list, and that Cal Atlantic at number 4 has an average closing price of $450,000, so it's impressive that it made the top 5. However, when you look at the top 10 builders' performance, 70% of the closings in the past 12 months were below $300,000. So in summary, increasing supply is helping to satisfy market demand. Lot deliveries, single-family starts, and under construction inventories are at or approaching record highs. There's significant activity below 300,000, which fuels the market. And we see growth along major commuting routes, especially 130 and 183A. Biggest builders in Austin continue to dominate the market, and those builders and others are adjusting product and moving out to address affordability concerns. But there's pressure on builder margins due to increased labor costs, materials costs, and development and permitting time and cost. However, despite its challenges, Austin is still a highly desirable place to live, and I anticipate 2017 to end as one of our strongest years. Thank you.